The stock might sound boring, but has been on a rampage over the past 10 years, being up almost 300%, and in most recent times it's been up 17.18% over the last 6 months. We are talking about Home Depot, ticker HT. The stock is currently trading at a little over $400 and is trading at the higher end of its 52-week range. Home Depot is beloved by investors because of the dividends it's paying. You might question this, as the starting dividend yield is only 2.19%. It's decent, but not very spectacular. Well, it's not only this low starting dividend yield what attracts investors, it is because the company is a powerhouse when it comes to increasing the dividend payments each and every year. Where it only paid 4 cents a quarter in 2000, it is now paying $2.25 every quarter. This is an increase of 5,525%. Looking at it from a standpoint of 10 years ago, your dividend yield would be 2.75%. Nothing special, but if you would have held on to the stock for 10 years, your dividend yield would increase to over 11%, meaning you would get $110 every year for every $1,000 you'd invest. Let's go over the latest earnings report, look at the financials of the last 10 years and use these valuation models to see if Home Depot is at a buying opportunity. The latest earnings report looks very healthy, with a reported sales of $40.2 billion for just that quarter, an increase of 6.6% from the year prior. The earnings per share was $3.67 compared to $3.81 the year prior. Even though, because there has been and still will be many macroeconomic uncertainties in the world, the quarter performance exceeded the expectations of Home Depot set by the CEO. Well, what did Wall Street expect? Wall Street says about the same, where they expected an EPS of $3.64 and a revenue of $39.32 billion, whilst the reported revenue was $40.22 billion. So overall, that's looking very healthy. Even though the quarterly results look great, the full fiscal 2024 guidance might say otherwise. The company expects sales to decline about 2.5% and there will be approximately 12 new stores. So what about the financials of Home Depot? First off, I'd like to look at the dividends of the company. The dividends grew from $2.08 in 2014 to $8.36 in 2023, and now being exactly $9. This makes the 10-year dividend CAGR close to 15% and a 5-year CAGR 15.20%. These are huge increases for a home improvement retailer. These increases sound great, but at the same time worry me. Just look at the free cash flow payout ratio. Remember, dividends are paid out of free cash flow. So Home Depot needing to use half of his free cash flow to pay out dividends gives me something to think about. Despite the high ratio, we can see over here that the free cash flow is absolutely skyrocketing. The 10-year free cash flow CAGR is 15% and for the 5-year CAGR is 15.67%. This makes the dividends and free cash flow grow at about the same rate. And we can see, looking at the payout ratio over the last 10 years, it's kind of stable between 40 and 60%, 2023 being the exception. Knowing Home Depot is a home improvement retailer and sells products with lots and lots of stores all over, including having a website, Home Depot needs to manage their inventory quite carefully with the thousands of different products they sell. And because Home Depot ties up a lot of its cash to its inventory, they need to be careful at exactly how much of their cash they use, as they don't want to get into the situation where they can't pay off their debts anymore. As we can see, the total debt keeps on rising each and every year. The current ratio tells us a bit more about this. And we can see from the past 10 years, this is being stable and most often above 1, meaning there's more current assets than there are current liabilities. This makes it so Home Depot won't get in any trouble quickly when it comes to paying off debts. So let's move on to the valuation models and see how much Home Depot is actually worth. First off, we will use the discounted cash flow model, which by predicting the future free cash flows, can calculate the intrinsic value. We will use a growth rate of 12% and a discount rate of 9%. Adding all the future free cash flows together, adding the cash and cash equivalents and subtracting the total debt, we come to an equity value for Home Depot. By dividing this by the shares outstanding, we come to $427.43 per share. Another way to calculate the intrinsic value is the dividend discount model. Based on future dividend payments, we can find this value. With historical data and a dividend growth rate of 6%, we can calculate the intrinsic value coming to $318 exactly. Even though the historical growth rate is much higher than the one we use for the future, I believe 10.62% is nowhere near sustainable. So moving on to the third valuation model, we will use different businesses to evaluate Home Depot. The businesses are Lowe's, Target, Walmart and Floor & Decor. Using their PE ratio and the EPS of Home Depot, we come to a price per share of $404.13. The thing is, I don't just want to evaluate the company to others, but also compare Home Depot to itself. So we're going to take a look at the price to earnings ratio of Home Depot over the past decade. We can see that the current PE is 28.33, whilst the average is a bit above 20, giving us a 27.61% difference. If we would apply this to the stock price and calculate when it would be acceptable to buy, the stock price has to drop below $300. The last model I want to use is Graham's valuation model, named after Benjamin Graham, the mentor of the great oracle of Omaha, Warren Buffett. The model calculates the intrinsic value based on current market conditions. By plugging in the variables EPS, projected growth rate and current yield on AAA bonds, we get an intrinsic value of $284.56. The thing with this model is that it is too reliant on market conditions. Say we would have used this model in 2020, the current yield on AAA bonds would only be around 1.5%. This would change the price to over $975 per share. When combining the calculated values of all the models, we come to an intrinsic value of $358.53. This doesn't come close to the current market price, and on top of that, the current PE ratio is a lot higher than its average. I have to agree to the calculated intrinsic value. I don't believe that Home Depot is worth buying right now. Also, looking at the price history, Home Depot was valued at this level of intrinsic value not even 6 months ago. In July. I will put Home Depot on my watch list, but not a single second I will think about buying the stock at its current price. What I will be buying, even though it is at its all-time high, is Visa. Watch this video and find out why Visa is a must-have in your dividend growing portfolio. Don't forget to like and subscribe to join a community of dividend investors, all with the same goal: reaching financial freedom. Thanks for watching.